All right. Greetings, everybody. It's Jeff Scott. It's September 6, 2015, and welcome to this weekend's top-down review. I've entitled it Market on the Brink, followed by a number of dots. The challenge is this the brink of a bounce or a brink of another leg down? I think this is a long weekend. China was closed Thursday and Friday. I'm dictating this on Sunday. It will be, I guess, later this evening we'll get some China futures out, at least for Sunday night, and they'll open up in a couple of hours. Our futures will be closed for another day. Certainly, interesting times, whichever way we go. Disclaimer: this for education purposes only. Any and all recommendations should be considered and are in the spirit of education and not investment advice. I am a doctor, not a broker. I am not affiliated with any software company, vendor, or trading company. The tools that I demonstrate are tools that I have paid for and the exact same tools that I use in my daily trading. I accept no payments from anybody, and nothing that anybody pays me for would drive any of my opinions. Trading involves risks, and you alone are solely responsible for any investment decisions you make, and you should assume you will lose money. Lots of conversation, taxi cabs, sitting around the airports about whether or not we've had a bear market. A brother-in-law of mine, who I don't think's ever traded, actually called me and asked what the market's doing. So perhaps when you get to that level of Main Street, it's exuberance to the downside, and maybe that's partly why we're due a pop. Regardless, time will tell if this is a bear or not, and your number one job is protect your nest egg and live to fight again. Not going to spend much time here, but the key influences that I've had have been canceling with O'Neill, Woodward Brown, Ian Woodward and Ron Brown. Happy birthday, 85 to Ian today. I really took the rules of canceling, expanded upon them, and applied them electronically with HGSI software. Morales and Catcher, who worked for O'Neill and then have taken his teachings further with Bible gap ups, pocket pivots, etc. And then John Person, who really helps me learn to go from finding a stock that looks good to when to actually take the trade and how to manage the trade. Author, trader, and becoming a fast friend of mine. I have a lot of programs, but I do not use everything I bought. In fact, part of the reason why I do these programs or these videos is to help you learn how to use the programs you paid for, specifically HGSI, EdgeRater, and some of the things in TradeStation and Thinkorswim that I like. I use TradeStation and Thinkorswim and Genesis. There's strengths and weaknesses in each of them. I use HGSI for my delayed during the day and certainly my end of day monitoring and evaluation and analysis. EdgeRater just makes so much of what I do easier. I'll show you some of the things I do in EdgeRater today. And then I do seasonality, and there are a number of websites I follow. So I start with what I called here my Friday sector review. And I think this is just, to me, a very interesting picture of the market that we're in, and gives you sort of an idea of what the end of the day Friday looked like. Now, it's interesting, I watched my portfolio performance, and my long-term portfolio, which has some hedging, was actually down a little bit, or a lot, most of the day. Came back, turned positive around 330, 345, and finished a little bit down. So the market did a pretty impressive comeback later in the day. That said, as you could see across the board, except for biotech and some of the airlines, it was pretty much weakness throughout. If I look at the major markets, it's not a pretty picture. Whether I look at the E-minis, the NQs, the YMs, the TFs, these are the VIX and the dollar in the lower right-hand corner, so they may or may not be as correlated. I see the same thing, which is big move down, clear downtrends across the board. We've had death crosses, in each of the markets as well, with the 50 crossing below the 200. And perhaps we're setting up some wedges, but the big question remains, was the prior week's lows putting in a bottom, or are we going to bounce around sideways, retest the bottom before we go higher? Time will tell. Bears are clearly in charge, and whether you look at 5-minute bars across the top of the major indices, daily or weekly, you can see sell signals everywhere with the bears firmly in charge. Interest rates, I thought, were a little bit interesting this week. And this is a weekly chart where interest rates came back down to test support. I didn't know what to expect with the Fed report. It was a weak report from employment numbers. It was a strong report from unemployment average. And then everybody talks about how August is always revised upwards with an average of 75,000. So I start to put all that stuff together, and I come up with a story that says maybe it wasn't a weak report. If we're going to raise rates, then rates should be going higher. The fact that they actually closed a little bit down on the week, perhaps we're being telegraphed that rates are not going up. Why do rates matter to investors? Well, they matter for a lot of reasons. I don't think we'll be getting to a place anytime soon where the market would be considered not accommodating. But clearly certain things such as the regional banks and insurers benefit from rising rates, while things that pay dividends or need lots of money for their growth, such as REITs, MLPs, utilities, and home builders and dividend payers, will benefit from falling rates. When the market has sensed a weak economy, rates have fallen on that accord, and that's not good for anybody, and I don't think that's what's driving the little rate decrease that we saw this week. Probably more thinking September 17th will become less of an issue. I follow a lot of third parties. Two entities that I really sort of use as my go-to to keep me in front of the bear are Lowry Research and Investec Research. Both of them are pretty much saying the same thing, which is short-term sell signals, but probably correction, not necessarily a bear market. And you could see in Lowry that the selling power is still above the buying power, which is bearish, and that you have a falling AD lines across the boat. Looking at AD lines differently, weekly on the left and daily on the right, if this was a stock, you'd be shorting it. And I think that's part of the problem with the market is the AD lines continue to head down. If one looks at the number of stocks that are above or below major moving averages, if you look at the number of stocks above the 200-day SMA, just pointing out that we broke through our trend line support here, but basically we've dropped down to about 14% of stocks are above their 200-day. This here is 2011. That's been the pullback that I've been watching and wondering if we're not going to mimic that. I placed something on the HGSI board that actually looked at potential downside targets. This wash out of the market with only about 2% of the stocks being above the 200-day moving average occurred in the last bear market. If one looks at stocks above the 40-day, this is on a weekly chart rather, you can see 2011, we've pretty much gotten down to that level. Why are these things important? Because historically, when the market has pulled down to these levels is when the market has reversed. So if one's looking for a reversal, these might give you a little bit of ammo on that side of the ledger. Now, the canaries last week looked like they were leading the market higher. They got hammered this week. Netflix probably leading them down, but the Canary Index was down 9.3%. I use this to help me understand which indexes, or rather to be a leading indicator that when this rolls over, I'm going to get concerned that the overall markets may be rolling over as well. And we've seen in the past, leading indexes can lead both to the upside and the downside. And maybe we'll gap up on the open on Tuesday and give us somewhat of an abandoned baby signal there. But right now, it's hard to say that this is anything except looking very weak and worrisome. Market thoughts. Short term, we're in a solid downtrend. Majority of individual stocks have entered into bear territory. While the Fed debates a September rate hike, this should dominate the headlines over the next couple of weeks. We are oversold and perhaps getting close to where we might see a short-term bounce. And any bounce might be used to unload long positions and find better places to short. And what is the next shoe to drop? It's certainly been China the last couple of weeks. Greece has an election. I'm not sure the timing of it, but I know that the seating party is sort of putting things to a test. The last time they had an election had to do with whether or not they should follow the EU, and they said no in the election, and they did anyways. Is it auto debt? Is it education debt? Is it going to be this new crisis of the refugees in Europe? Longer term, still feel like we're in topping action. Slowing worldwide economy versus full employment in the U.S. puts the Fed in the hot seat. As I mentioned before, this feels a lot like October 2011, September 2011. Corrections are normal, do not mean we're entering a big bear market. However, risk management is prudent. And reality, the question of whether we are in a bear or not may not be meaningful, since so many individual stocks are in bear territory. This is the cover of Barron's this week. I guess I probably should ask permission to use this. But I think the point I want to show you is their headline, U.S. stocks could rise more than 10% by year end. And I think the big black words say it all. We've got a strong market, probably have a pretty good economy, but in a crazy world. As I've always told you, stock patterns are cyclical. You need to know where we are. Clearly, we are now in stage 4. The question is whether we're getting close to a bottom, or is this just the beginning? Again, being in that stage 4, how you play the market should be different than it was in stage 2. I'm buying bear call spreads. I'm buying puts. I'm selling calls. I'm shorting stock, doing contra ETFs. Now, I'm not totally convinced that this is going to go down in the abyss and that we're not going to bounce up. And I have taken a few long positions, but as I'll demonstrate with TTPH, I'm not just doing straight long positions. I'm looking at ways to mitigate some of my risk. Know your news and EPS highlights. There are some employment numbers as usual on the beginning of the week, claims, continuous claims. We've got some inventories, we got some energy, and we got Michigan sentiment. We are at a point now where we'll see less and less earnings reports until we start the next cycle, but there's still some big ones there. If you are into retail, we've got things such as Conn's, Francesca's. We have Lululemon. We have a number other things that might be interesting. We got some solar plays, YGE. So I think you always have to be aware, and as I said before, it's a judgment call to hold stocks over earnings dates, and it's bad judgment to not know when your stock earnings date is scheduled. This comes from levittbrothers.com. Here's the link. Chart of the week, as I've started doing this over the last several weeks, is I wanted just to show you how I look at a stock, how I work through a stock, and the types of things that I consider, and then how I'm going to trade them. I'm planning on taking most of these trades when they occur, and that will force me to tell you what I did and why. Not all are going to work, but all of them will have stops so I don't lose my shirt. So last week I liked TTPH. This was a week ago. I talked about bouncing off the 200. Here was that crazy Monday where everything had hard to believe pricing, $28 on a stock that ended the day around 40. I liked it because I had a PSA reversal. I'm coming off support. I had a mobile breakout from a squeeze, a pocket pivot, and a kahuna. When I looked at it, I said I was going to buy it if it took out 44.50. My stop was at 39.35. I thought it was a little risky because that's $5.15. I also didn't think I had a better choice as I looked at my options for the week. Well, what happened? It was a tough week in the markets with the markets down 3%. TTPH triggered the price on Thursday when the FDA gave it a innovator designation, which is well thought of by the street. So I looked at the stock. I said, market's in correction mode. Tough to take new longs. I looked at options, and boy, were they expensive. An at-the-money $45 option was $6.50 with a October strike price. What that meant was I'd have to pay $6.50 to control a share of TTPH for approximately 6 weeks at the current traded price, or just above the traded price. So, considering the market was in a bad place, the stock has held up remarkably well. I decided to buy shares of the stock at $44.50 and then immediately sell 30 calls for $45 a pop, pocketing $6.50. I think that's called a buy right or a covered right, a covered call, whatever you want to call it. The point here is that I did a couple of things. If the market takes off tomorrow and this stock goes to the moon, I've limited my gain to 50 cents plus $6.50 or $7 a share. And I'll get that gain in about 6 weeks of holding, which is between 18 and 20% return in 6 weeks. If the market goes sideways and the stock, say, trades down to 43, I lose $1.50 on the stock, but I pocket the $6.50 of the call. Once we get to the third Friday of October, if the stock is trading below 45, the option expires worthless. The $6.50 actually reduces my cost of this position to $38 a share, which gives me a fairly dramatic cushion and makes it difficult for me to lose money unless the stock has a correction of about 15-18%. So I decided to take sort of the safe approach. I'd be happy to pocket that $7 in 7 trading weeks, and we'll see what happens. This week, this is my chart pattern of the week. This is another biotech, or it's called, and I know nothing about it, RxDX. Ignita rather, is the name of the company. I picked this purely on technical means. I have a clear stock in an uptrend. It had a big move up with a viable gap up. Still has not broken the bottom of the gap up, but did retrace significantly, putting in a bottom about 10 days ago. Today, or Friday, it broke above the 50-day moving average with a kahuna. It also had a kahuna on Wednesday, stalling at the 50-day moving average. It is coming out of a squeeze, and my technicals up top have turned green. So I like a lot about what I see about this stock. Again, I recognize the market. So new PPS weekly, you could see here it had a buy signal on the weekly charts. It also just finished a high close doji Wednesday on the daily charts and is in a daily PPS buy within the person indicators. OBV broke above trend line, which is another thing. The bongos turned positive this week and had a PSA reversal in a squeeze as well as the kahuna lighting down here. So if the market's not in a free fall, I'll have a buy stop placed above the high at 1545. My target to take off half is 1690. That's a little bit better than a 1-to-1 risk. My risk is $1.20 with a stop at 1425. risking 7.7%. The way I would trade this stock is I would buy 1,650 shares for every $2,000 of risk that I'm willing to take. I will take off half if I break through 1690 and let the rest run and raise my stop to break in even at that point, and then trail it up as the stock goes higher. So we'll see how that pick goes next week. Again, I like the chart pattern. I do not like the market. If the market sells off, I will not get filled. And if I decide to not take the trade, even if the stock goes above my buy price, I'll probably put a note out on the HGSI board saying that I've taken the trade off. Again, these are for teaching, for education. It's allowing me to talk through how I'm going to manage it. This is not a buy or sell recommendation for your portfolio. So those are my introductory comments. Let's take a look at the market, a little bit of top-down analysis, bottoms-up review, and then I'm going to throw in a bonus session tonight, which is going to make this long. I'll go back to the PowerPoints and talk about how I use my tools to hunt for bears. Upcoming live events, October 16th to 18th, Greg Mills Orange County meeting, headlined by George Lee. There's 5 or 6 speakers, including myself. Happy birthday, Ian Woodward, turned 85 years old today. I believe it's 85. October 24th through 26th, PV meeting with Ron Brown. I will not be there, unfortunately, because I have a wedding to attend. And then October 31st to November 2nd, I'll be speaking at John Person's seminar here in Palm Beach Gardens. Hopefully get to see you in Florida next year at my meeting, or perhaps even earlier at one of the other meetings. Let's look at last week very quickly. In my group performance analysis from HGSI, unfortunately, as you know, it was a very difficult week. Broken Out and Running was one of my buy list. Only one stock. It had a great week, and I know what that is already, but to show its energy focus. Had a Bible gap up around 14, which got me into the stock. It's one of the big winners right now, if there are such things as winners. But you can see a sea of red as most lists went down. IBD 50 was down 3.72, in line with the S&P 500 at 3.4. My buy watch list, or just list of stocks I look to buy, not necessarily things that I did buy, about the same performance as the S&P, with 2/3 of them down. And then the best of Woodward and Brown was also down 2.22%. The HGS 100, which amounted to 38 stocks this week, was down about 2%. There really isn't anything to say good things about. This was a very difficult week in the market. From a Hindenburg perspective, there is no Hindi. The number of new lows is 4.12% in the NYSE index. The number of new highs, 0.19. And hopefully you remember, to get a Hindi, you need to have new highs and new lows both being above 2.2%. A rising MA on the index, McClellan less than 0, and new highs cannot be less than twice the new lows. They're less than or equal to twice the new lows. So they can't be more than twice the number of new lows. I said that bad. And you could see we've only got one button hit, which is new highs are less than twice the new lows. So no Hindenburg. Buckets show us that we are firmly in the bear camp, with 87% of the stocks remaining below the midline of the Bollinger Band. However, we've come off our lows, and now the largest component are in the 30% range. What that means is the percent B is between 30 and 40, which means stocks that are firmly below the midline of the Bollinger Band. Now, what's interesting, and I scratched my head, is the Woody indicator in the markets has held up as green. Now, I think the flaw here is that the bandwidth has gotten so wide that percent B times the bandwidth is being held up not by the percent B, but by the wide bandwidth. So I'll be tracking that and see where we end up there. Seasonality. There are some things here that work. I've just taken my list of tradable stocks, $2 and 150,000 shares, and looked at a number of years up over the last 20 years. I could take it further and I could do things such as look at those stocks over the next month is what I'm looking at here, and looking at how they've performed. And to get on this list, I pruned it by keeping no more than 3 down years, minimum of 8 up years. So for example, Calidus Software, CALD, up an average of 7% over the next month, 10 out of 11 years positive. So these were the big winners on seasonality, and these were the big losses. Apollo Investment Group, Hilltop Holdings as a bank, New York Mortgage Trust, WebMD, so on and so forth. Now, what I'm really excited about is my new shorting sheet within EdgeRater, and I'm just putting a plug in it that I'm going to come back and at the end and show you how I use that to find candidates to short. All right, let's kill that, and let's take a look at TradeStation and see if I've got any signals in there. I think I learned something over the last couple of weeks, and what I've learned is that when a buy signal is seen in the dailies, but a sell in the weekly, to have caution. And all that means is a retracement in a downtrend, because we've had some of that scenario and the market has not really responded to the upside. So let's look at the E-minis. Now I wonder, I think they'd be trading tonight. Let me just double check here. I may be wrong, but my guess is they're, well, 6:49 p.m. Eastern Daylight Time. So I guess the futures are going to trade for a little while tonight. And it's the cash markets will be closed tomorrow. So we are seeing some movement in the futures up, as you can see right here. But let's just take a look. Here's the E-minis. You could see, now here's what we're looking at here, folks. We're looking at the arrows have now replaced the dots. Those are John Person buy and sell signals. The color of the bar is from Alexander Elder, where green is a buy, red is a sell, and blue is sort of the hold. And the way that he says about it is, when it's green, I have permission to buy, but no permission to go short. When it's red, I have permission to sell, but I have no permission to go long. And when it's blue, I'm free to make my own decision. We'll look for evidence of oversold, which would be little dots at the end, above or below, and which is a not oversold, but really MACD divergence. The high jumps are going to be out of the picture because the markets are all sold off. So I look at the E-minis. I see a blue on a sell on the dailies, sell on the weekly, sell on the monthly. So a nice little bounce today. It's a retracement in a downtrend until proven otherwise. On the NQs, sell signal blue, weekly and monthly red, same thing, a potential retracement in a downtrend until proven otherwise. The YMs, similar story, sell signal on Person, blue on Elder today, so perhaps a little retracement, red on the weeklies. And then if I look at the Russell futures, these little green dots represented some MACD convergence, perhaps a bullish addition to a falling chart. But as you could see, it did not keep the stock from falling further. It's currently in a Person sell on a Elder blue, so perhaps a retracement in a downtrend. If I look at cash markets, the NASDAQ, the Dow, the IWM for the Russell, all in a downtrend. The Qs in a downtrend. The SOX, the SOX, actually ran up this week, but now retraced to the 2 moving averages and was turned back with a sell signal. Hard to get excited to the long side by any of those findings. Eventually we'll pop. We'll start to see more blue on the Elder color and arrow signals to the upside. We're not seeing them right now. If you look at the sectors, basic materials, sell across the board. Energy really was bouncing off the bottom, went to an Elder sell on Friday, Blue with some MACD divergence on the weekly, red on the monthly. Looks a little bit better than the indexes, but still in a downtrend, retracement in a downtrend. Financials went to a sell signal on Tuesday. Little blue here, but red on the weekly and the monthly. Industrials, sell signal. Technology, sell signal. Staples, sell signal, although a little bit of blue on the color bars. Utilities has been in a sell signal with just a massive drop. Healthcare had been the strength of the market in a sell signal. And lastly, discretionary in a buy signal. So discretionary, energy, probably looking the best, but overall, a lot of pain in the markets. Now, this is something that John Person showed in his room, so I want to call out that I do get a lot of information from him. And John is a big fan of the Commitment of Traders report. And the Commitment of Traders report looks at futures and divides the purchasing into three categories. Yellow would be, well, actually blue would be professional, like hedge funds, professional traders that have to report their position size. The red are commercial entities, and I look at commercial entities as buying futures or selling futures because of their main business rather than their expectation of the economy because they're hedging something. And then in yellow are the non-measured or non-reported, which are the small speculators, us. And what John pointed out was that we have continued to be at our highs in the amount of shares short. These are E-mini futures, amount of long contracts rather, for the individuals like us. So we are massively long, while the professionals and the commercials are both short. The fact that this market keeps going lower, and as of Tuesday's reporting of this, the small specs have not given up their positions, would be potential ammo for the bears who see perhaps some element of exuberance in this market still. Just to give you an idea of past performance, if one goes to 2008, as the market was dropping, we were long until the end of 2008. The professionals came in late 2008, and by the time the market bottomed, the non-commercials, the small specs, went net short and stayed net short for about a year of the recovery, missing most of the run-up. So the fact that we are so long at this point could be conferred as more bearish information. All right, so we've looked at the state of the markets. Let's take a look at things in HGSI. We're going to open up the warehouse view, and let's go to the Major Markets Plus. Sorry about that. T1 view, so all price and volume heavily weighted towards the last day, the last week, a little bit for 3 weeks. And we could see the strength of the market, the dollar, treasury bonds, gold and silver and volatility. Looks pretty defensive to me. If I look at 5-day performance, I can see volatility leads, and then gold down 6, utilities down over 5, and the major indexes all down in the 3% range. Let's take a look at some of our favorites, see if we can't make any further hide or tail of this. I'll be coming back to this view later. It's one of my favorite views right now. I'm going to leave everything on for a second. I just wanted to point out that there were no kahunas at the end last week, but this would be on Tuesday, I believe. And this is a Phoenix. So we had another exuberance follow-through day to the downside. So the S&P 500, it'd be nice to think that we have some higher lows, but we also have lower highs. So we're in a wedge. And, is this just a bear pennant forming? And are we going to break to the downside and retest? And frankly, I'm in that camp, although I'd be very pleasantly surprised. And I might be in one camp or the other. It doesn't mean I don't that I'm all in one way or the other. Do we come back and retest here, or do we come back and retest closer to the 200 and the 50-day moving average on the upside? All I can say is we're in a nice little wedge there. I think that potentially there's more risk to the downside. The good news is that we're not that far away. We're maybe 60 points away from an S&P 500 retest. I don't think that by any means is out of the question. Take a look at the Dow Jones Industrials. Sort of a similar pattern here, as we are sort of in a wedge, figuring out, are we going to break to the upside or come back down and retest the lows? I can look at the NASDAQ. NASDAQ perhaps broke down below these lows that we were seeing. Depends where you want to draw the trend line, but clearly at best case scenario, NASDAQ is also in a wedge formation, although it does look like it may have dropped out on Friday. And the Russell 2000. Similar story, in a wedge. So it'll be very interesting to see what happens as the market goes forward. Now, it's also interesting when I just look back here to see what had been support on the way up may now turn out to be resistance on the way down. So we are clearly in downtrends on each of these indexes, and you should be trading as such. We look at the dollar. Dollar really didn't do that much this week. Here's where it closed on Friday, Monday, Tuesday. So up just a tad on the week, which means gold and silver, if just looking at dollar strength, could have had decent weeks, and they did not. Gold ended the week selling off, as did silver. Green candles, but on the week, I guess, about no change on silver. The VIX remains, I guess, the most volatile, no pun intended, of the indexes. And it, too, is sort of in a bit of a wedge. And it'll be interesting to see how long it takes for this VIX to come back to normal. As long as this VIX is bouncing up, we're going to continue to have market turmoil. There are ways to play the VIX. I played it this week with some UVXY calls. Very volatile, extremely volatile. You can also play VXX, TVIX, are different ways to perhaps protect your portfolio by doing some insurance. All right, enough of the major indexes. Let's take a look at industry groups. We have 173. Two-day force up, we're down to a total of 7. There are not a lot to love in the longs. Airlines, changed to index group. I have several of these. Probably the majority of my holdings right now are airlines. And perhaps I should think about lightening these up, although, off of the lows, they've had a big move here. And if I just ignore that leg down, Delta still had a nice move. At the most part, it's sideways over the last several months. Had a big run up from over the last couple of years. holding. Doesn't look that exciting right here. Let's go to my typical view for a stock. And basically, at best case, going sideways, holding its own. Now, going sideways in this market, this is the relative strength in blue of the stock versus the S&P 500. The dash, I believe, is a 21-day moving average. And what this shows me is that the delta, although it's going sideways, is very much outperforming the market itself. So that's delta. JetBlue, perhaps one of the best of these, uptrend, sideways, had a kahuna on Wednesday, looks more like it might want to go than delta. SkyWest, a small one. Alaska Air, the other one that's got, looks like it wants to break out as well. So in a really bad tape, those may be the best charts you're going to see within a single industry group. Now, I'll take that back. Commercial residential building, I'll show you the best chart you're going to see. For several weeks I've been talking about how some of the offshoots of the construction world were benefiting from sort of a construction boom. So Energy Focus is not a new name, although it's a new name to many of us. This is a stock that's been around for a while. In fact, we can take a look at monthly. You can see it's been around since January of 2005. At one point, prior to the last correction and probably a few reverse splits, it would have been worth $154 a share back in 2005. If you look at what this company does, go up to the top here, designs, develops, manufactures, and markets fiber optic lighting for a wide range of use in general commercial and pool and spa lighting. I tell you, we're building a new house, and based upon what my wife spent on lighting, I could see why companies like that are being successful, clearly taking advantage of a boom in building. If you look at least at the next couple of quarters, the last several quarters, big turnaround story as earnings have turned positive with great momentum, big multiple, but earnings growth rate much larger. The percent demand supply, which is new in HGSI over the last couple of updates, anything above 2 I found to be showing a lot of accumulation of a stock. There's a lot of demand for Energy Focus. I said you could have got in about 14. That would have been on this day here. Where I got in, we had a kahuna, a Bible gap up off of the 50-day with a PSCR reversal, a MOBO breakout. There was a squeeze, I believe, and most of the technicals up top turned positive. You could see its relative strength is greater than the S&P, and at new highs. It looked like perhaps it was topping on Thursday, had a good day on Friday. Not sure what it means, but much of Friday's improvement came in the last 30 minutes of the day. A.O. Smith, same group. This one's involved in water heating. At an interesting buy point sitting on the 200-day moving average. I'd look to see momentum coming in before I got too excited, right below the PSAR dot. It's been beaten up pretty bad. And that's the last one above the index. I usually don't look at stocks performing less than their index is. Marine shipping. And I've talked about this several times and pointed out that not all marine shippers in our database are the same. You have the dry bulk shippers, which for the most part continue to underperform. And then you have those that ship oil. The oil ones are interesting because they charge about $1 a barrel a month to take oil that's excess and put it in a tanker which sits in the Gulf. Since it's sitting in the Gulf, it's probably utilizing a lot less gas and it's much cheaper to run. And these things pay big dividends, and as long as we have an oil glut, they're probably going to do well. I've been in and out of NAT. Here's TNK. Again, sitting on the 200, had a PSAR reversal. Big earnings per share growth rate for now. Pays a dividend that's small at 1.9%. Something's got to give when your growth rate is 800%, 1,000%, 100%, 70, 800, 160, and your multiple is only 6.83. Nordic has a multiple of 20. Look at the growth rates, 2,800, 4,200, pays a 10.9% dividend. That's pretty exciting to me. So they're paying about $1.60, $1.70, which means they've got to have decent earnings flow to pay that. Break above 50 with some volume or momentum might get me interested in being an NAT again. Golar LNG, a little bit different story. I'm not as excited by that chart, nor Euro NAV. So I think the first two, TNK and NAT, look interesting. Truckers, I guess they're benefiting from an economy that's still strong and from low gas prices. I have to admit, I didn't get a lot of truckers when I went through my charts this weekend. Werner, to me, it's still well under the 50 and the 200 in a downtrend. From a relative performance perspective versus the S&P, yeah, it turned up the last couple of days as the S&P sold off, but I don't see anything that I really like in this chart. Conway, Heartland, J.B. Hunt, you know, they're all bottom fishing. None of them look too exciting to me. Again, the market itself was selling off, and they didn't sell off much. That makes that bullish. Medical equipment index. A lot nicer looking charts, although this one's pulled back below the 50. Hologics, but it's clearly in an uptrend. I'd like to see it retake the 50 and show me some momentum. Ceres Corp, I do like this chart. Let me just look at the weekly. So it's kind of flat, a little bit left to right. It's probably too cheap for me to buy. What I like about this is it's coming off the 50, mobile breakout from a squeeze, everything turning green in a kahuna, and relative strength moving up and crossed above its moving average about 10 days ago. I'll show you what that means later on. Cheap stock, I like the pattern. I don't usually buy stocks that are this cheap. Volume is 850,000. Integra Life Sciences, uptrend pullback to major support. A couple of kahunas, mobile breakout from a squeeze. I'd like to see it break above the 50, but I think that's a compelling looking chart as well. Sinosure, it's at the 200, a little bit beaten up for my taste. Department stores. This one's kind of amazing. JCPenney's has closed up well, it depends on this day. 1, 2, 3, 4, 5, 6, 7 days closing up, or 9 out of 10 days it closed to the upside. Something's going on with JCPenney, not a stock that I typically follow or own, but it's broke above its prior highs. Interesting chart. Everything turned green here. It's had a number of kahunas to the upside. Dillard's, big downtrend. Sears, not as exciting. Stage. So this is a group that's being driven by price and volume of JCPenney's. And restaurants, I guess we have to keep eating. Dave & Buster's Play. I used to go there. It was fun when I had kids. Uptrend pullback. It's at the 50, a couple of pocket pivots. That might be something to look at. I'd like to see it break above the 50 with a kahuna. Buffalo Wild Wings, sort of setting up a high base here. Expensive stock in a tough market. Wendy's Corp, nah. Domino's, will it bounce? I don't like buying stocks in downtrends, although it could bounce off the 200. That was it to the upside, folks. A rather quick report, as there wasn't a whole lot of compelling stories. To the downside, you can see we've got 63 groups to the downside, and they include everything. Diversified banks, e-commerce, so you know what that's going to mean. Things like, Alibaba, Vips, eBay, REITs, communication equipment, large pharma, oil exploration, integrated oil, semis, oil, gas. You know, these top ones seem to bounce one day or the other between winners and losers. They have big volume, Doesn't take much to flip them. But most of the high growth sectors are clearly running to the downside. Now, how do I find stocks to short? Let's table that for a couple of minutes. I want to show you a couple of other things, and then we're going to move forward. Now, if you're new to HGSI, there's a world of value. He's not new to HGSI. That sits up here, hold on one second, in the smart groups. And in the smart groups, you have a number of scans from different people, myself included. And just go into the designer. And you don't really need to do much more than open up the smart groups and look at Woodward and Brown and take a look at what are the best of stocks, what are the best of under $15, what are the leaders, potential short sells, and David Ghilardi. Some of the best things to look at for good stocks are the sprinters. In my group, I have a number of things I like. I like volume. I like to look at MOBO breakouts and breakdowns, especially from a squeeze. Breakdowns from a squeeze. Short candidates break out from a squeeze. I like to look for pullbacks to the 50 of the Kahuna. There were none this week. And I like to look stocks squeezing with potential PSA reversal to the upside, of which there were a couple. So often I might not have time to do my full analysis, so I look at my favorite scans. Another thing that I often do to find some leaders is just hit my warehouse view and just put on a simple scorecard combo. Make sure you go to all securities here. And it will bring the best stocks in the market to the top. Volaris has been a very well thought of airline stock. I think it's South American. One of the problems here is I've got some cheap stocks with little volume. So one of the things that I do is I put a scorecard combo filter, and I'll leave it at $2, 2.5, and 150. And then these are the top stocks that come up. Just let's look at the first 10 and show you how easy it would be to find some good-looking stocks. So Volaris, I just looked at. This is a South American airline. Of all the airline stocks, it's got one of the nicest looking charts right below a PSA reversal. Had kahunas, a mobile breakout from a squeeze. Looks very nice. Flammo is a biotech stock that's sort of basing, but it was basing last week and I didn't pick it. Looks interesting in a squeeze. I'd like to see momentum come in. Energy Focus, we already looked at the EFOI. TK Tankers already looked at. The Hackett Group, Commercial Services, don't know what they do. Best Practice Research and Advisory Program. Strategic Advisor and Answer Think Company, okay. A nice uptrend sitting right above the 50, right below the PSAR dot. Looks like in a good position that you might see a reversal to the upside if there's market strength. Aaron's Rental Center, again, sitting right on the 50, right below the PSAR docket with the mobile breakout from a squeeze and a pocket pivot. A breakout above the PSAR dot would make this an interesting play. JetBlue, we looked at already. Installed Building Products is in the same group as EFOI, sitting on the 50, looking for some momentum. I'd want to see that first. And the list goes on. SkyWest, small airline, but breaking out, or a feeder airline. And then Jack's Pacific is a retail play, or leisure products rather, toys and games, sitting on the 50, had a kahuna on Friday, and that might be one that might be interesting. So just by looking at all securities in a scorecard combo, I can find some great stocks. And that scorecard combo, the power of that is it brings the best stocks to the top. So I did go through my list. Before I work on the short side, let me just show you some of the longs that looked interesting to me. Many of these we've already looked at. You can stop the video and take notes if you want to. I looked at each of them, and then I ran them through my person filters. And let me show you the ones that I really liked at the end of the day. Some of them you've already seen. Jack's Pacific, again, toys and games, leisure products, uptrend, sideways to the 50, big squeeze, all the moving averages coming together, and a kahuna. This one might be ready to run. Aaron's rental, consumer goods rental, similar pattern on the 50. Needs some momentum, needs to take out the PSAR dot. It is squeezing, looks like it's ready to run as well. Advanced drainage systems, like this one a lot. Again, in the construction business, great earnings per share growth, pays a dinky dividend, uptrend pullback to the 50. Give me a kahuna, give me some momentum. I might be in that stock. AMM Healthcare Services, AHS, beautiful tight uptrend, bounced off the 50 on Tuesday, right below the 17. A little bit of momentum could get me into that stock. WCI Communities, one of the two home builders that looked good. I think LGI was the other that I liked. Mobile breakout from a squeeze and a kahuna. Broke above the PSAR on Friday. And then Ignita, the one that I used as my chart of the week. And this one's not supposed to be there. Just for the sake of argument, let me just drop into my trade station and show you how I looked at these with the person indicators. So I put the entire list into of all the buy list stocks I was looking at, and I'll do the same for my shorts later on this weekend. And then I went through and looked at each of them, and I'll show you the different patterns and my thoughts about them. Just see what futures are doing out of curiosity. They've dropped down. They're still up, but less than they were before. China will be interesting this weekend, obviously. AAN, Aaron Rents. This one was a tough one for me to pass on. Let me give you a little bit of a explanation of what you're looking at here. The red and green arrows are John Person's PPS buy and sell signals. These long lines here are the monthly pivot support and resistance. This is the Person histogram. This is on balance volume. I have a bongo calculated now, which looks at daily, weekly, and monthly. You can see they're all turning up. These are my dots. There's 7 dots. The top dot, if you get one, is a Bible gap up dot. The second dot down is a pocket pivot. The third dot down is a mobile breakout or breakdown. The fourth dot is a squeeze. The fifth dot is a PSAR, green or red. The sixth dot, if you see one, would be for a red candle high or a green candle low, potential reversal. And the last dot, or the first dot from top to bottom up, would be a kahuna force. So I've got the best of HGSI, I've got my OBV, and I got my person buy signals. This is daily, next one is weekly, the third one is monthly. I saw on this one, broke the OBV moving average, which I like, in a squeeze with a mobile breakout and a pocket pivot. Bongos are positive. A buy signal came in. Weekly in a buy signal, monthly in a buy signal. Like this stock a lot. It's on my buy list, and it almost became my buy of the week. WMS is that the Advanced Drainage Systems company. Looking at this one, in a person buy signal, had a high close doji one on Thursday. OBV breaking above its moving average. It's in a daily bongo. Too new to have a monthly bongo. Weekly bongo is negative. PSAR is supportive. It's in a weekly buy, although it's gone nowhere. On the weekly, not been traded a long time. Technically doesn't look as strong. I like their story. It's in the right type of sector. AHS, again, weekly buy, daily buy. OBV trending up, although it did drop below its moving average, and a small pullback with the daily bongos green. Weekly bongos, daily bongos red, weekly and monthly are green. You can see PSAR is above it. I'd like to see the PSAR flip before I took it. AVOL is another new stock that had a buyable gap up. So you had the buyable gap up, a pocket pivot, a mobile breakout, a PSAR reversal, and a kahuna force on Friday. Look at OBV going to the moon. Buy signal here, buy signal on the weekly. Again, another one that I strongly considered for my stock of the week. E should not be there, so let's just make E go away. RXDX is that in Glida. You see the OBV taking off, OBV taking off. You see a buy signal here, a buy signal on the weekly, bunch of my green lights firing. This was my, this is AVOL, I'm sorry. RXDX, this is the one that should be breaking over its trend line. All right, so it's still got a little ways to work on the OBV on the daily. It's about to break on the weekly. My bongos are green. It's coming out of a squeeze. It had a high close doji and a buy signal here. Had a weekly buy signal here, which is what I liked it for. This is RXDX. Here's Jack Pacifics, the toy and leisure. It's in a daily buy. It's in a weekly sell, which was enough for me not to take it. OBV is so strong, I guess it's off the chart. Let's see if I can bring OBV back home. Here it is. OBV heading up, and then the WCIC was that builder, high close doji and a daily buy, weekly buy, OBV heading up weekly, heading up daily in a squeeze. Those were the, of all my list of longs that I went through, those are the ones that I found most compelling. Hold on one second. Let me pause this for a second. All right, I got through that in an hour and 1 minute. So that's probably a new world record, but it's probably because there were so few stocks to the long side. I want to take you on a journey of how I look at things to short and how I manage my portfolio during markets like this. I title this The Short Side. Again, the same disclaimer in case you didn't watch the earlier video. This is educational purposes only. Doctor, not a broker. Trading involves risk. So here's my playbook for the dark side. Cash is king. Need to keep some dry powder for the next bull. I don't want to know when the next bull is coming. I want no margin. I want to have a lot of free cash so I can make aggressive purchases when I think the market turns. I also have to be careful because some of the market's biggest rallies, we've seen a couple in the last 2 weeks, have occurred in bear markets. Opportunities exist in that with those rallies to unload longs, and new shorting opportunities might be found at higher prices. Most stocks will fall during a bear market, so be very careful initiating and holding long positions. And despite your concerns, you are not likely to miss the next bull market while you are sitting on the sidelines waiting on confirmation of a new sustainable uptrend. Again, what I've done of late is I've raised cash by selling all laggards. I placed collars on long-term positions. What that meant was I bought a put at the money. That put may have cost me 5%, 3% of the value of that stock. I then sell an out-of-the-money call and sell a deep out-of-the-money put. And together, those two will often pay off the cost of my at-the-money put. So hence, I protected my value of my portfolio, at least of that entity, and have paid for it by selling premium. Now, if the market takes off and goes up a lot, I run the risk of having my stock called away to my out-of-the-money call. So if I have a choice of selling my stock today at $10 or having it called away at $15 and getting the premium on that, I think I'll take the $15. I also have the ability to buy back my call or roll it up and out instead of letting my stock go to the option holder. The other risk I take is if the stock drops so much that it drops below my out-of-the-money, deep out-of-the-money put, I've capped my protection with the amount between the put that I'm long and the put that I'm short. I also have a tendency to purchase insurance on my portfolio as a whole, both to protect unprotected holdings as well as to make money on the downside. I personally like to do index puts. OEX, the Qs are my favorites. The S&P 100s, the NASDAQ 100s. I play a lot of contra ETFs. Pick whatever your market is, and then based upon risk tolerance, you could be 1x, 2x, or 3x. Now, if you own an IRA account and you're not allowed to short and you can't do fancy options positions, there is a good chance that you will have the ability to buy contra ETFs that will mimic the opposite direction of an index. So if you think the S&P 500 is going down 10%, you could buy a number of different ETFs. I like SD as in David S, and play the market so that as the S&P goes down, the SDS goes up. So you're buying an instrument that looks and behaves like a stock, but will track the opposite to what the performance is of the S&P. I will short individual stocks, and I will buy puts on individual stocks. These are the types of things that I'm doing right now. And sometimes you get a gift like we did a couple Mondays ago when I was short a bunch of Netflix at about 240 and got out at 197. Now, the best book in the world for shorting, at least the world that I live in, is a new book by Gil Morales and Chris Katcher, Short Selling with the O'Neill Disciples, Turn to the Dark Side of Trading. Highly, highly recommended. Although I love Amazon, I think if I had to do it over again, I would actually buy the book itself instead of downloading it on Amazon, obviously buying it for Amazon. And the reason is I'd rather have the chart that I can flip back and forth, which is a lot easier in paper than it is electronically. How I find short candidates. Gil often says he finds his best short candidates from his most recent winners and buying lists. And if you think about one of the beginning things that Ian used to teach us is that growth stocks or high growth stocks go up like rockets and they fall like rocks. So if you want to find things that are falling, maybe we want to find things that are falling like a rock. And so the same growth stocks that went up might lead to the bottom. I might look for patterns, head and shoulder tops, failure at moving averages. Several of my HGSI indicators that I use, bongos reverting to the downside, kahunas to the downside, the super special and not so secret Chris Wilson charts, which I'll show you. I use person indicators as PPS sells and low close doji, and I can do this with my various scanning tools, which I'm going to show you real quick, and always have stops and targets available. In HGSI, I like my PSER reversal to downside in a squeeze, which is a smart group. Mobile breakdowns in a squeeze, which is a smart group. Red candle highs, which is a smart group. Stocks and groups move to the downside, which is a smart group under Ian's name. And various candlestick patterns, which I could scan for, including evening stars. Bearish engulfing. Shooting stars. This is an intro into Chris's charts. You can't really see much, but this is what sits on my desktop when I do my weekend review. TradeStation's behind it. And what the point here is that there's a lot of amazing charting ability within HGSI. And on the right are the Chris Wilson charts. And I'm going to show you why I love those charts. I'm not going to give you his email because you'll inundate him. But he used to give these charts away. And I will email him and ask if I have permission to share them with people that request them. I sit here with a designer window, a warehouse window, daily charts, and a weekly chart. In the Chris Wilson template, you have the bongo weekly here. This is a weekly chart, weekly bongos, weekly kahunas, weekly stock prices with a 10-day, 10 weekly, 21 weekly, and 40 weekly moving average. And then we have a relative performance of the stock versus the S&P in red, and then their 21-day moving average of that line. Here's the amazing thing. When the stars line up and I see a bongo weekly, a kahuna weekly, and a breakdown through the moving averages, and I see a break below the moving average here, I want to go in and I want to short that stock. We haven't had, for me, I like to short in times of tough markets. You can certainly short during good markets. This is a short of HCP, which is a REIT, and the short would have been taken in May of this year when the market was going sideways. I would cover my short based upon a trail, based upon closing above moving averages, or perhaps I would wait till I got down here where we closed above the moving average of the relative strength chart, broke above the 21 weekly moving average, had a kahuna to the upside, and the weekly bongo went green. We had another shorting opportunity here with the parameters being met of the relative strength of the stock crossing below the relative strength of the S&P and its moving average. Stock breaking down through the moving averages, bongos, and a kahuna. HCLP, this was a fracking stock. I was looking for this when I hit HCP and I said, gee, that one had the same pattern. Weekly bongo, kahuna, breakdown, breakdown, and even if you didn't short it until this point, from 63 down to about 15. What I have found, and I follow my shorts with this, and granted this is a weekly, and I'll probably get tactical on the daily. If it doesn't hold above the relative strength line, the moving average of the relative strength line, it's just a retracement, and I can re-short it, or I can continue to hold my short. Here's Apollo Education, same pattern, broke below. Great shorting opportunity, cover it down here. So, I cannot scan, unfortunately, an HGSI for this, although I did send in a request to George and Matt to see if we can scan for this cross. And if we can, then I'll be able to do this in HGSI. I've come up with another formula that might mimic that, but I haven't tested it yet. So I called my friend Chris White and said, Chris, I want a shorting template. So let me show you a little bit about that shorting template. I've got a list of stocks here, and I'm going to hit run. And it's going to go through my stocks, and it's going to bring up to the top those stocks that I might be interested in shorting. The criteria that it's looking at will be breakdown of weekly moving average support, weekly bongo going to sell, weekly kahunas to the downside, and any combination thereof. So, it's funny, there's a couple stocks that I like, but I got to do some filtering here. Let me make sure I ran this on today's date. Yep. So I like to have crossed above, below, below. Bongo to the downside. I only want I don't want stocks that are going back up, so take out the up. Okay. All right, so these are stocks that had a crossover today where price broke below either the 40 or the 20 today on the weekly averages. Actually, it's 21 the way I ran that. This is how many weeks or days since a crossover of the 20 or the 40. I'm looking here for whether or not you crossed below the weekly, the relative strength versus the S&P crossing below its moving average, and bongos. So let's find some things that might be expensive. And let's only look at stocks above $30. Say 40. Illumina. All right, hold on a second. It should be opening up with a different template. All right. Huh. For whatever reason, it's not giving me the crossover here. So let's take a look at a couple of these charts with the CRIS charts. So let's hit Allow Editing. Whoops. Oh, let me do some more changes here. All right, I did something silly. So let me close this out and open up one that I was playing with before. Okay. As you can tell, I'm still learning what the appropriate ways of setting this up. This was run. Here's your Illumina. That looks right. Cross below today the 40. 3 days ago, crossed below the 20. The relative strength crossed below 2 days ago. Weekly bongo 6 days ago. All right. ILMN, let me get into HGSI. By the way, Chris's charts are ancient. And they were sitting on my computer, and we haven't really been in a market that I really wanted to short as much as I want to short this one. So here is Illumina. Big uptrend. Yes, it's come way off of its top, sitting right below the 40-week moving average, which it crossed under. Looking to the right side, it looks like it's about to cross under here. It meets my criteria. All I need here is a kahuna to the downside to come in, and I might take this in the next couple of days. Gilead, that was on the list. How's Gilead look? Whoops. Crossing below the relative strength line, failing at the 40-week moving average, a new kahuna, and a new weekly bongo. Gilead makes this list. What else is on the list? And again, the purpose of a scan, HDB and BCPC. HDB, same thing, hasn't broken below here yet, getting close below the 40-week moving average. had a kahuna here to the downside and a weekly bongo. Balchem Corporation. Nope, not close yet on the relative strength thing. So basically, what I do is I will, and I've been spending a lot of time this weekend, the more and more stocks that I look at, Dollar Tree is another one, DLTR, the more and more stocks that I look at who've fallen have this meet those criteria where the S&P, where the relative strength of the S&P exceeds the relative strength of the stock. The stock crosses below its moving average as it's doing here with a kahuna to the downside and a weekly bongo. And although the stock has come down some, what a great shorting opportunity. Now, I might drop this into a weekly and then wait for a retest before I go and short this again. It's already fallen quite a bit. And if this market rebounds at all, Dollar Tree runs back up to the 40-week, or in this case, the 20-week moving average or the 40, and fails, and that's when I short it. So I get strategic and find potential shorting candidates on the weekly. I take the trade more likely on the daily. Back to my PowerPoint. You can't see it, that's why I went into the program. You can run it of any date and you can sort of test. And what I'm really working on is how do I want to filter these, as in what's the appropriate ones to bring to the top so I don't have to go all the way down the list to find the best candidates. I've also looked at adding additional indicators, which you can do on your own as well. Then let me show you what I do with John's scans. Teach you a little bit about the low close doji, and then we're going to say goodbye. One of the reasons why I use John's stuff is because, well, it works, but also because of the scanning tools in TradeStation. So let's go and look for daily high close dojis. I got a lot of different lists. I'm just going to pick this one. And there's a lot here. So let's see if there's something. Wow, are there a lot? Let's look at Goldman Sachs. So a high close doji would be defined as stock's been a low close doji rather. Stock has been in an uptrend. So it's come off the uptrend. So this would probably be a better candidate up in here, but it's come off the uptrend. So, but let's just assume it was still in an uptrend. It was an uptrend this week before it had the sell-off. All right, stock is in an uptrend. You have a doji. In TradeStation, we paint that doji blue. You actually had two dojis in a row. If within the next 3 bars, you close above the high of that doji, that would be considered a high close doji. If you close below the bottom of the doji, it's a low close doji. That is a trading system by itself. You either short at the close of this day or at the open the next day. It has a very high winning percentage. If you read John's books or do any of his mentoring, you'll figure out where you put your stops and your targets. It's one of the best signals that I trade. Now, I would look at this stock and I would notice that it's in a weekly sell for some time, all the way from 210 down to 180. It had a low close doji today, had one back here. I'd look for it to trigger a further move to the downside. OBV failed at the moving average and is heading down. It's in weekly bongos are to the downside. The only thing that's green here is a think that would probably be the PSAR dot. And that would be a potential shorting candidate. FFIV had a low, clearly in an uptrend, had a low close doji on Thursday, a doji on Thursday. We'll go outside in 1 second. Sorry about that. My dog's ready to go. Had a low close doji on Friday. OBV about to break its moving average. Bongos are negative. So the low close doji itself gives me candidates for shorting, and boy, there's 89 of them this weekend. The sell signals also are potential candidates to short, and sometimes you'll get both of them at the same time. Here's FedEx. FedEx in an uptrend on a monthly sell, a weekly sell, and now a daily sell. OBV failed at its moving average. The weekly and monthly bongos are negative. So I will use John's indicators and scans as a great vehicle for finding shorts as well. On that note, I'm going to go take my dog for a walk. Hope you found some value from this. Good luck. We can go up from here. I don't think we're in a bear market. I think we're in a correction. I think we got a little work to do to get out of this correction.